When it comes to investing, most people focus a lot of their energy on choosing the right investments. But wealth is not just about how much you earn, it's also about how much you keep. That's why the best investment strategy in most cases is simply making sure you lose less. Less to inflation, less to fees, less to taxes. Hello everyone, my name is Mojukwe and today we'll be talking about something that often beats investment returns. Tax savings. Quick reminder, this course is for education only. It's based primarily on my experience and personal research. I'm not a financial advisor and I'm definitely not a tax expert. If you do need a financial or tax consultant, do reach out to a licensed professional. When it comes to investing, most people focus a lot of their energy on picking the right stock or finding the highest return or getting an extra 2% here, 3% there. But something I learned a while back is that the best investment is often just reducing your tax bill. Reducing your taxes is one of the few guaranteed ways to improve your investment outcomes. A 20% tax savings is a guaranteed percentage, the guaranteed figure. A 20% investment is not. Usually when we talk about the stock market growth over time and we say average of 10%, that's average. In some years it goes above, in some years it goes below, in some years it's a decline. The last 5-year average for the S&P 500 has been 11% roughly. But in 2022, it was a decline. But if you have a tax savings, it's a tax savings. There is no average over time, it is a tax saving. If you ignore existing tax allowances, and there are a lot in this country, you're literally leaving money on the table. Let me give you an example. If two higher rate taxpayers both invest £1,000 in the stock market and one person uses the tax wrapper, the other person doesn't, without knowing the returns of that investment, we already know that one person is going to earn less than the other without even seeing the impact of the investment. The person with the tax wrapper is already guaranteed to save on any dividends that they receive from that £1,000 investment. On the other hand, the person without the tax wrapper is going to be looking at a tax bill of about 33%. That's almost a third of whatever they make above their dividend allowance from that £1,000 investment. They could invest in exactly the same stock or ETF and earn vastly different amount of returns. One person gets more by simply keeping more of what they earned. That's why when you think about it, the best investment strategy in most cases is simply making sure you lose less. Less to inflation, less to fees, less to taxes. Now, this is not about avoiding taxes. It's about using the many tax protections and allowances that already exist in the UK. A few examples of tax protections and allowances that people already use include things like the popular ISAs. So for ISAs, you have cash ISAs, you have stocks and shares ISAs, you have lifetime ISAs, you have junior ISAs, you have innovative finance ISAs. And then you also have pension contributions. You have other protections like gift aid for those of us that give to charities. It's particularly useful for high taxpayers because you gain back the additional tax you pay on anything that you donate to a registered charity. And then you also have employer share schemes. Some of us see these things in our companies, but we don't realize that there are actually opportunities to also, beyond the investment itself, save a bit of tax. Basically, an employer share scheme is a tax advantage way to invest in your employer, to invest in the company that you're working. And then you also have tax allowances for your different investments, meaning depending on your tax band, you are allowed to earn up to a particular amount on your savings, dividends, capital gains before you have to pay taxes on the extra. That's why they call it an allowance. You only pay taxes on what is above the allowance. Now, side note on capital gains. Capital gains basically means whatever you gain after you've held onto an investment for a period of time, or you've held onto an asset for a period of time. So for instance, if you buy shares at £1,000 and you wait 5 years and it goes up to £1,500, your capital gain is the £500 on top. Now, depending on how you bought those shares in, if you bought it in an ISA, then there's nothing you need to do. But if you bought it in a general investment account, then you have an allowance And anything above that allowance, you need to pay tax to the government on top. With property, it's very similar as well. You buy your house, £500,000, you wait 5 years, the value of the house has gone up to £750,000. Your capital gain in that scenario is the £250,000 on top. If it's a house you live in though, you don't need to pay any taxes on that based off the current laws. If it's your primary residence where you live and you're selling that to move somewhere else, you might be able to avoid paying capital gains tax on that because there's an exemption if the property is your primary residence. But then you don't need to memorize every single allowance or remember every single rule for two reasons. One, the rules change quite frequently. So unless it's your day job, it's going to be difficult for you to memorize every single one of them. But more importantly, you just need to know that the rules exist, the allowances exist, and find out what allowances apply to you in your own circumstance as of today. And then where to find the information about which allowances apply to you in your own particular situation as of today. One more thing on allowances. If you are married, if you're a couple, there are other options you could actually consider when it comes to allowances. Some allowances can be managed across two people. For instance, if we take a look at ISAs, each year, everyone in the UK has an allowance of £20,000 that they can invest tax-free every year, meaning whatever dividends, interests, capital gains that you make on that £20,000 over the lifetime of that account is going to be completely tax-free. Interesting thing is, even if you leave the UK, so long as that money sits in that account, it's going to continue to be tax-free in the UK. Again, based off today's rules. Now, as a couple, the implication is you each have the same allowance of £20,000, even if only one person is earning or only one person is a higher taxpayer. So if you're in a committed relationship, you can utilize that £40,000 combined allowance each year. Not a relationship advisor either. There are also certain allowances that can actually be transferred from spouse to spouse. I'll leave links in the description for where you can go into all these details. Just remember that ignoring this is leaving money on the table. Now, we're not going to cover every single tax allowance or opportunity that exists in the UK today. But the lesson is for you to know that tax planning is as important to your financial well-being as identifying the right investments, if not more important. Now, your exercise for today is simple. Identify just one tax allowance or tax wrapper or tax protection that you intend to use. If you don't know any yet, find out one. We already discussed ISAs. That's the easiest one that everybody should be using. But if you already were using an ISA, try and find another one. It could be your investment allowances like your savings interest allowance, your dividend allowance, capital gains allowance, gift aid, voluntary pension contributions. Whatever it is, try and identify one more tax allowance that you could benefit from this year. Bookmark the government page that explains it so you will know when the rates change and when they change the rules around it. Lastly, put a date in your calendar that you're going to act on that particular allowance. It could be the day you start your voluntary contribution or identify a charity in the UK that is registered for gift aid. I will leave links as usual in the video description. Please bookmark them, particularly the ones on the official HMRC website or the gov.uk website. The exact rules or figures for each allowance may change over time. So it's good to always check, especially when you want to apply one of the allowances. The good thing is usually it takes a while before those changes kick in. So by the time you usually need it, the new rules would have been circulated. But it's always good to check. Now, even if you don't do self-assessments, you should still do your own personal assessment of which tax allowances you could benefit from and which ones you should keep an eye on if they are changing. For instance, if you want to sell property, you want to know what's happening with capital gains and things like that. This is one area where sometimes it might be particularly helpful to get professional advice, depending on your situation. If you have any questions on this topic, please leave it in the comments. And also let me know if you learned about any new tax allowance today. Maybe you just heard about gift aid for the first time. That's it for today. Remember, wealth is not just about how much you earn, it's also about how much you keep. I'll see you tomorrow.